Hey, what is going on, guys? Rules for Rebels here. Doing something a little bit different today. Today, we're going to be answering the question of what is an index fund and what is indexing or what is index investing. So, while we typically talk business on this channel, personal finance and things like that are also important. I think everybody's goal in being an entrepreneur is to build wealth, get security, get freedom, etc. And part of that is making money and finding ways to make money. And another part of that is being smart about the ways that you spend your money. So everything from budgeting to investing to everything else that has to do with personal finance. Lately, I'm getting into a lot of like Dave Ramsey stuff and a lot of other, kind of investment related podcasts and YouTube channels and things like that. Well, we typically talk about business. I have made some videos in the past about Betterment and Wealthfront and Bitcoins and other types of investments and things like that. And I've actually been meaning to do another video kind of updating you guys. I'm no longer using Wealthfront. I'm no longer using Betterment. And I've slowly started selling off individual stocks and just investing in index funds. So I just wanted to talk. A couple people have asked me some questions about this, and I just wanted to lay out kind of the basics of what an index fund is. And if any of you guys are interested in like learning about some different index funds available to you, I will mention some of those as well. So traditionally, actively managed mutual funds basically hire an expert. And it was that expert's job to go out and decide which funds to buy. Index funds don't work like that. Index funds simply track a third-party index, something such as the Dow Jones, the S&P 500, the Russell. They create a list of securities that represent that stock market, that index, I should say. And it doesn't necessarily hold all the stocks in that fund, but it will hold a lot of them. It will represent it. And basically, the goal is to match that. So if you have something like VINFX, which is a Vanguard fund, it aims to match the S&P 500. Now, what you're looking at right now is the Vanguard Total Stock Market Fund, VTSAX, and this is what's called an Admiral Share. When you're with Vanguard, once you get $10,000 or more into a fund, they give you a lower expense ratio that basically matches that of the similar ETF. What I like about mutual funds is that you can kind of set up a trickle so that each week or each month, whatever you want to do, money comes out of your bank account or via direct deposit and goes straight into whatever fund that is. So that's one advantage of a mutual fund as opposed to doing an ETF where you're actively going to have to log into your account and go buy a stock. Also, you can trickle the money in and buy partial shares with a mutual fund, whereas with an ETF, if the price of the ETF is $87, if you have $50, you're not going to be able to buy anything. Now, I've made some pretty good money investing in the stock market. I actually bought my first house off like $700 that I ran up to I don't know, probably somewhere around 10 grand, which was my down payment on the place. And I kind of started getting a little bit cocky and thinking I was a really good investor. And in reality, I first got interested in investing in the stock market right after the, 2006, 2007, 2008 housing crash. So literally, you probably could have thrown darts at a wall and picked winning stocks that would have made you money. So after the market recovered, I realized that I wasn't quite as good of an investor as I thought I was. And this kind of leads me to my next point, which is back in the 1970s, some financial experts did some studies and realized that many of these actively managed mutual funds do not outperform the indexes themselves. And on top of that, you're paying fees to have them manage your money, and they're not even matching, the S&P 500 or whatever other index. So Vanguard, I think, was one of the first ones to create index funds. I could be mistaken on that. Somebody correct me if I'm wrong. But they basically created index funds in which the manager of that fund basically just goes out and buys the securities or the stocks to try to mirror or match that index, and it's typically at lower fees as well. Now, an index is basically the measurement or the measuring board, for lack of a better word, to determine if you may hear, oh, this mutual fund outperformed the market or underperformed the market. So right here, the blue line is VTSAX, which is Vanguard's total stock market index. The green line is the S&P 500. So Vanguard's VTSAX, essentially you can see here the lines are pretty much on top of each other almost all the time. Here it underperformed a little bit, but it essentially matches the performance of the S&P 500. Now this orange line, let's say hypothetically this were a managed index fund. this managed index fund would have underperformed the index fund because it's under here. If this orange line hypothetically were above there and it were representing a managed mutual fund, it would mean that it outperformed. So, my kind of thought, like I said, I made some money investing in individual stocks, quite a bit of it in some cases. However, I've also lost a lot of money, essentially betting on individual stocks because essentially, none of us can predict what's going to happen with the market. We can make educated guesses. But right now, I mean, if you look at my stock portfolio, God, I have a lot of stocks, a lot of ETFs, but the vast majority of them are up and some of them are up considerably. However, I'm sitting on quite a bit of, I think a couple, 100 and something shares of Twitter stock, which is worth like less than half of what I bought it at. I forget the other one, but there's another stock that I'm down on quite a bit. So when you're picking individual stocks, I don't want to say you're not diversified. I suppose you could buy a collection of stocks that are diversified, but it's one company. So if that company, something shitty happens to it, like Twitter, it's just a terrible company, you're going to lose money. Whereas if you're investing in index funds, unless the entire market goes to shit, you may do better at times and worse at times, but overall, you're typically going to be up money as long as the entire market isn't down. And I mean, I should have logged into my Schwab right now and showed you, but essentially you can see out of the 30 to 50 stocks I own, probably 90% plus of them are in the green. Of all the ETFs I own, most of them are in the green, but I have like 2 stocks dragging me down and I'm sitting on a $2,400 loss right now. So I've kind of come of the mindset that I'm going to stop trying to invest in individual stocks. Look at all the, I know there's all these articles about millennials buying Snapchat because they like Snapchat, but I mean, everybody who bought Snapchat at $24, $26, $28, $29, the stock's sitting at like $19, if not less than that right now. So picking individual stocks, I've realized just isn't for me. Even if you're good, even if you're right 8 times out of 10, if you put a bunch of money into those 1 or 2 stocks that don't perform very well, you could be down money despite, overall picking pretty good stocks. So I'm kind of transferring over to index investing. I had tried Wealthfront and Betterment, and while I didn't lose money, I just felt like the gains weren't really stacking up well against what the market was doing. I think I had like 15 grand in Betterment, I don't know, 5 or 10 grand in Wealthfront. And I mean, over the course of probably the last year and a half, 2 years, I'm up like $111. I think both Wealthfront and Betterment have too much international exposure. They also hold some bonds, and they're charging you fees to essentially just buy Vanguard funds. So I'm actually going to talk more about this in another video. I've actually closed out those and opened up a Vanguard account. I think Vanguard's like investing back into their website is pretty piss poor in terms of user friendliness and the dashboard and things like that. But I mean, if all I'm going to do is throw all my money into VTSAX and then, have $200 a week or whatever it may be coming out of my checking account going into there, it's not something I'm going to be logging into. It's not something where I need a really fancy dashboard. So I'm okay with that. So I will be making a follow-up video where I talk about Wealthfront and Betterment and why I stopped using them and which, I'm a big fan of Schwab. I'm a big fan of Vanguard. Not so keen on Scottrade, although Scottrade has a decent back-end dashboard. But I've gotten a couple questions asking like, what is index investing, or like, what do you do for your investments and things like that. So I've done a lot of stuff. I'm switching over to pretty much index investing. Just to throw out a couple of, personally, I think Vanguard, if you are going to employ this strategy, I think Vanguard is probably the way to go. They typically tend to be much lower on fees. They're not spending a bunch of money on marketing or on having a fancy website or anything like that. They're basically trying to offer you the lowest fees possible. And just some examples of some index funds would be something like VSIAX. And I should also mention that as opposed to buying the mutual fund, you can also buy an ETF version of this. The ETF would be VBR, and that's like a small cap index fund. VFINX, I think that may be Admiral shares. And with Vanguard, you have like, what do they call them? I think regular investor shares, and then they have Admiral shares. Once your investment in an individual fund hits $10,000, you can either manually transfer over to Admiral shares, or it will happen at the end of the month and you get a lower expense ratio. But VFINX is Vanguard's index fund that matches the S&P 500. I should have looked this up. I want to say VTI is the ETF version of that, but those are some examples of index funds. And again, that's what index funds are. That's what index investing is. Rather than you trying to pick specific stocks, or rather than buying a mutual fund in which the manager is trying to pick stocks to outperform the market, you're literally just buying something that is going to mirror what the market's doing. And typically the fees are going to be a little bit lower than an actively managed fund. So hopefully that answers that question for you. Again, I'm not an expert. If anybody wants to correct anything I said, feel free to do so in the comments section below. And if any of you guys have anything you want to share in terms of mutual funds that you like, I don't know, questions you have, what brokers you like, anything like that, feel free to drop a comment in the comment section below. I'd also be curious from any of you guys using Robo investors. Are you happy with them? Are you not happy with them? Like I said, I was kind of underwhelmed with Wealthfront and Betterment. However, I am kind of a fan of Schwab's Robo investor. I think they call it an intelligent portfolio. But that's actually up quite a bit of money for me, and that one is doing pretty good. But anyhow, hopefully you guys enjoyed the video. If you're not subscribed, please click that subscribe button below the video. Drop your questions, comments, or anything you have to say in the description box below. And I will catch you on the next video. I'll try to get one posted tomorrow, but if I don't post one tomorrow, I'll catch you guys on Tuesday for episode 4 of the Side Hustling series, as well as Thursday. We got 2 great episodes coming up later this week, so I'll catch you guys then.